There is a moment that happens in every market crash that almost nobody notices. Not because it is hidden, because it happens in plain sight, at the moment when everyone is looking somewhere else. The moment is this. The people who caused the crash are buying. Not trying to stop it, not caught in it like everyone else. Buying. Quietly, systematically, at prices that will not be available for long. From sellers who are too panicked to think clearly, and too emotionally overwhelmed to hold. This is not a conspiracy theory. It is not a claim that powerful people sit in rooms and decide to crash markets. The mechanism is more interesting than that, and more disturbing, because it does not require coordination. It does not require a plan. It requires only the exploitation of a specific psychological vulnerability that exists in every retail investor, every ordinary market participant, every person who has ever checked their portfolio during a downturn and felt the specific terror of watching their financial future dissolve in real time. That vulnerability has a name. Economists call it liquidity preference. Behavioral psychologists call it loss aversion. The people who exploit it have a different name for the dynamic they produce, a name that most financial media never uses. Psychological illiquidity. This video is about what it is, how it works, why the 1% use it, and what understanding it reveals about every market movement you have ever watched with confusion, fear, or a sickening sense that the game was rigged before you sat down to play it. It was not rigged. It was something more sophisticated than that. It was engineered. Liquidity, in financial terms, is the ease with which an asset can be converted to cash without significant loss of value. A liquid asset is one you can sell quickly, at or near its market price. An illiquid asset is one where selling quickly requires accepting a significant discount. Psychological illiquidity is something different. It is not a property of the asset. It is a property of the investor. It is the state in which a person who holds a perfectly liquid asset, a stock that could be sold in seconds at market price, becomes functionally unable to make rational decisions about that asset because their emotional and psychological state has been pushed beyond the threshold where rational decision-making operates. The asset is liquid. The investor is not. They are frozen, not by any external constraint, but by the specific combination of fear, loss aversion, social comparison, information overload, and time pressure that market conditions can create, and that sophisticated actors have learned to deliberately manufacture. In a state of psychological illiquidity, the retail investor does the opposite of what rational analysis would prescribe. When they should hold, they sell. When they should buy, they freeze. When they should ignore the noise, they respond to it. When they should wait, they act. And when they act at the worst possible moment, at the prices that benefit whoever is on the other side of their transaction. Whoever is on the other side of their transaction is almost always the 1%. The mechanism that produces psychological illiquidity is not complicated. It operates through 4 primary drivers, each of which amplifies the others: loss aversion, information asymmetry, social contagion, and time compression. Understanding each one is understanding how the trap works. The behavioral economics research of Kahneman and Tversky established something that market professionals have known intuitively for much longer. The psychological pain of losing $1 is approximately twice as powerful as the psychological pleasure of gaining $1. This asymmetry has profound implications for market behavior. It means that when markets are falling, the psychological pressure on retail investors is not proportional to their actual financial loss. It is doubled. A portfolio down 10% does not feel 10% worse than it felt when it was even. It feels 20% worse. The psychological pain overshoots the financial reality by a factor of 2. And it compounds. Because the loss does not just affect the investor's evaluation of the current situation, it affects their projection of the future. A portfolio that has fallen 10% does not feel like a portfolio that might recover. Under loss aversion and its companion bias, the availability heuristic, it feels like a portfolio that will fall further, possibly to 0. The brain extrapolates the current direction of travel into the future and presents that extrapolation as if it were a certainty rather than a panic-induced distortion. The sophisticated market participant understands this. They know that at a certain level of portfolio drawdown, a certain proportion of retail investors will be pushed past the threshold of rational decision-making and into the loss aversion-dominated state where selling at any price feels preferable to the continued psychological pain of holding. They know this threshold exists. They know approximately where it is, and they position themselves to be the buyer when retail investors cross it. The 1% do not have better information than retail investors in the sense that they have access to facts that retail investors cannot find. In the era of financial media saturation, most publicly available information reaches everyone at approximately the same time. What the 1% have is not better information. They have better information processing, and they have the ability to control the information environment in which retail investors process the information they receive. Information asymmetry, as a psychological weapon, operates not by withholding facts, but by flooding the zone. During a market decline, the financial media does not provide less information. It provides more. Significantly more. A torrent of analysis, commentary, prediction, counter-prediction, expert opinion, and narrative construction that creates not clarity but cognitive overload. Cognitive overload does not produce careful analysis. It produces heuristic shortcuts. It produces the availability bias, the tendency to weight the most recently heard, most vivid, most emotionally resonant information far above its actual evidential value. And the most recently heard, most vivid, most emotionally resonant information during a market decline is almost always bearish. Because bearish information is more psychologically urgent and therefore more compelling to the media that profits from engagement. The sophisticated market participant does not consume financial media during a downturn in the same way a retail investor does. They have already done their analysis. They have already established their positions. They are not processing new information. They are waiting for the retail investor's information overload to produce the behavioral response, the panic sale, that their own positioning requires. Human beings did not evolve to be contrarian. In the environment of evolutionary adaptation, the appropriate response to observing that everyone around you is running in the same direction was to run in the same direction. Because the alternative, standing still while the rest of the group fled, was likely to result in being eaten. The herd instinct is not irrational. It is the product of millions of years of survival selection. Financial markets are one of the few environments in which the herd instinct is systematically and reliably catastrophic. When everyone is selling, the rational action is often to hold or buy. When everyone is buying, the rational action is often to hold or sell. The market is the one environment where the herd is most reliably wrong at the extremes. And the herd is most reliably wrong at the extremes because the herd's behavior at the extremes is what creates the extremes. Social contagion amplifies psychological illiquidity in a specific way. When the retail investor watches their neighbors, their social media feed, their financial forums, and their family members all discussing the falling market in tones of increasing alarm. The loss aversion they are already experiencing is validated and amplified by social proof. It is not just their own fear telling them to sell. It is everyone's fear. And the evolutionary brain that interprets unanimous directional movement as survival information responds by intensifying the sell impulse to a level that overrides the rational mind's capacity to apply historical perspective, valuation analysis, or any other form of deliberate thought. The 1% are not susceptible to this contagion in the same way, not because they are psychologically superior, because their social reference group, the other sophisticated investors, the institutional analysts, the private conversations at the level where actual market intelligence is shared, is saying something completely different from what the financial media is broadcasting. The contagion reaches them, but it does not reach them through the same channels, and it does not carry the same signal. The final mechanism is the one that most directly converts psychological illiquidity into a wealth transfer mechanism. It is time compression, the manufactured sensation that the decision about what to do with your portfolio must be made now, immediately, before the situation gets worse, before you miss the window, before the opportunity to limit your losses closes. Time compression is manufactured at scale by the financial media, which operates on a cycle that is fundamentally incompatible with long-term investment decision-making. The financial media produces content every hour. Every hour requires a new narrative. Every new narrative requires urgency, because urgency drives engagement. The breaking news banner, the red font, the market is down and here is what you should do. All of it creates the felt sense that the decision window is closing in real time. The investor who makes financial decisions under time pressure is not making financial decisions. They are making psychological relief decisions. They are doing the thing that will reduce the urgency sensation fastest, regardless of whether that thing is financially optimal. And the thing that reduces the urgency sensation fastest is selling, converting the asset whose value is uncertain and falling into the cash whose value is certain and stable. The sophisticated market participant does not experience time compression in the same way, because they have already completed the analysis that the retail investor is desperately trying to complete in real time. They know what they will do at every price level before the price reaches that level. The decision was made before the urgency arrived. When the urgency arrives, they are not making decisions. They are executing a plan. The four mechanisms of psychological illiquidity, loss aversion, information asymmetry, social contagion, and time compression, operate naturally in any market downturn. They are features of human psychology that emerge whenever asset values fall significantly, but they can also be engineered. They can be deliberately triggered, amplified, and timed to produce predictable retail behavior that benefits sophisticated actors who have positioned themselves accordingly. The engineering takes several forms. The most direct is narrative construction. The financial media does not simply report on market movements. It constructs narratives that explain those movements. And the narratives it constructs during downturns are systematically more alarming than the underlying data justifies, because alarm drives engagement, and engagement drives revenue. This is not malicious coordination. It is the emergent property of an incentive structure that rewards attention capture over accuracy. But sophisticated actors can and do accelerate this dynamic. Short positions taken before a narrative shift can profit from the narrative shift they do not cause, but also do not discourage. Public statements by prominent financial figures, hedge fund managers, analysts, economists with media platforms that amplify bearish sentiment at moments when the sophisticated actor is positioned to benefit from the retail response to that sentiment are legal, common, and effectively invisible as a manipulation mechanism, because each individual statement can be defended as a sincere market assessment. The most sophisticated form of psychological illiquidity engineering is the creation of what traders call air pockets, moments of apparent liquidity vacuum, where automated selling triggers create a rapid price decline that has no fundamental basis, that triggers retail loss aversion and stop-loss orders simultaneously, that produces a price level at which the sophisticated actors pre-positioned buy orders execute at prices that will not be available once the artificial vacuum fills. The air pocket lasts minutes or hours. The retail investor who sold into it spends years wondering why the market recovered so quickly after they sold at the bottom. The sophisticated actor who bought at the bottom never wonders. They planned for it. The psychological illiquidity dynamic is visible in every major market event of the past century, if you know what you are looking at. In the 2008 financial crisis, the period of maximum retail panic, October 2008, when the S&P 500 fell 30% in a single month, or simultaneously the period of maximum institutional accumulation. Warren Buffett's famous New York Times op-ed, published October 16, 2008, titled, "I Am Buying American, I Am," was not written from a position of hope. It was written from a position of conviction that retail psychological illiquidity had pushed prices below any rational valuation threshold, and that the resulting buying opportunity was historic. While the financial media ran segments titled, "Is This the Great Depression 2.0?" Buffett was allocating capital at the fastest rate in Berkshire Hathaway's history. In March 2020, the COVID-19 crash produced the fastest market decline in recorded history, a 34% fall in 33 days. Retail investors, experiencing loss aversion, social contagion through social media channels that had not existed in 2008, and time compression via hourly market updates on every phone, sold at an unprecedented rate. Robinhood, the retail brokerage, crashed multiple times under the volume of selling orders. At the same moment, institutional investors were executing some of the largest buy programs in market history. The market recovered its full value within 6 months. Most retail investors who sold in March 2020 did not buy back in time to participate in the recovery. The pattern is not coincidental, it is structural. The mechanisms that produce retail panic selling are the same mechanisms that produce institutional buying opportunity. They are two sides of the same psychological dynamic, and the side you are on is determined not by intelligence or financial literacy, but by whether you have built the specific psychological architecture that makes you immune to psychological illiquidity when the mechanisms activate. The 1% are not immune to psychological illiquidity because they are psychologically superior. They are immune because they have built, through experience, through deliberate design, through the specific forms of institutional discipline that sophisticated investment organizations impose on their decision-making, an architecture that prevents the four mechanisms from operating on them as they operate on retail investors. The first component of this architecture is pre-commitment. Sophisticated investors make their decisions about what they will do at every significant price level before the market reaches those price levels. Not as a vague intention, but as a specific, documented, non-negotiable plan. If the asset reaches X price, they buy Y amount. The decision is made when the market is calm and rational analysis is possible. When the market is not calm, when the mechanisms of psychological illiquidity are active and pulling toward the panic response, the plan executes automatically. The decision has already been made. There is no decision to make under pressure. The second component is information filtering. Sophisticated investors do not consume financial media during market downturns in the way retail investors do. They have already formed their view of the asset's fundamental value. The media's narrative, the alarm, the crisis framing, the breaking news urgency, contains no new information relevant to their preformed analysis. They filter it out, not through willpower, but through the institutional structure of their decision-making process, which does not include real-time media monitoring as an input to investment decisions. The third component is reference group management. The social contagion of panic does not reach sophisticated investors through the same channels it reaches retail investors, because sophisticated investors' reference group is not experiencing panic. Their reference group, the other sophisticated investors they communicate with, is experiencing opportunity. The social signal they receive is the opposite of the social signal the retail investor receives from their social environment. Same market, opposite social information, opposite behavioral response. The fourth component is temporal architecture. Sophisticated investors measure their investment thesis in years and decades. The question for a retail investor watching their portfolio fall is what happens in the next week. The question for a sophisticated institutional investor is what this asset is worth in 5 to 10 years, and whether the current price represents a discount or a premium to that value. The temporal mismatch between these two questions produces opposite answers to the same market event. One answer is sell. One answer is buy. Understanding psychological illiquidity does not automatically protect you from it. The mechanisms operate below the level of intellectual understanding. Knowing that loss aversion is causing you to overweight the pain of a portfolio decline does not reduce the pain. Knowing that social contagion is amplifying your fear does not eliminate the fear. Knowing that time compression is manufacturing urgency does not dissolve the urgency. What it does is give you the framework to build the architecture that does protect you. Not intellectual protection, structural protection. The first structural protection is a written investment policy statement, a document that records, when markets are calm, your analysis of each asset you hold, the price levels at which you would buy more, the price levels at which you would sell, and the conditions that would constitute a genuine fundamental change in your thesis rather than a temporary market distortion. When the mechanisms of psychological illiquidity activate, you do not assess the situation. You refer to the document. The document was written by a version of you who was not under psychological pressure. Trust that version. The second structural protection is a media protocol. During significant market downturns, stop consuming financial media. Not reduce, stop. The financial media's incentive structure, attention capture through alarm, is directly aligned with the production of psychological illiquidity. Every minute you spend consuming financial media during a downturn is a minute spent being pushed toward the behavioral response that benefits the person on the other side of your eventual transaction. The third structural protection is a reference group audit. The social contagion of market panic is transmitted through your social environment. If your financial conversations during downturns are with people who are panicking, you will experience their panic as social validation of your own. Find or build a reference group whose relationship with market downturns is the relationship of someone who has built the architecture of psychological stability. Someone who sees falling prices as a function of opportunity rather than as a crisis. The fourth structural protection is the long arc. Extend your measurement of investment performance from weeks and months to years and decades. Not as an aspiration, but as a literal practice. Remove the daily portfolio value display from your financial accounts. Check quarterly. At the quarterly timescale, the mechanisms of psychological illiquidity lose most of their power because the temporal frame is long enough to contain the market volatility that triggers them. There is a transaction happening right now in financial markets that most participants cannot see. It is not hidden in the sense of being secret. It is hidden in the sense of operating at a level of psychological sophistication that is invisible to people who have not been taught to look for it. The transaction is this: the psychological vulnerability of the retail investor, their loss aversion, their susceptibility to information overload, their herd instinct, their response to manufactured urgency, is being converted, in every significant market movement, into a systematic wealth transfer from the accounts of people who feel their way through market downturns to the accounts of people who think their way through them. The 1% did not invent human psychology. They did not create loss aversion or herd instinct or the availability bias. What they did was understand these mechanisms with a precision that most people never develop, and build the institutional and personal architecture that makes them immune to the mechanisms that make everyone else predictable. Psychological illiquidity is the gap between what the retail investor knows they should do and what the activated mechanisms of their psychology cause them to do instead. It is not a character flaw. It is not a failure of intelligence. It is the predictable output of evolutionary psychology meeting a financial system that was built gradually, structurally, not through conspiracy, but through the emergent optimization of advantage around the exploitation of that output. You cannot eliminate the mechanisms. You can build the architecture that prevents them from determining your behavior. The next time markets fall, and the financial media tells you that the situation is unprecedented and urgent, and that you need to act now, remember what you know about what that moment actually is. It is the mechanism activating. It is the 1% waiting, and it is your architecture, or its absence, that determines which side of the transaction you end up on.